Delivering ongoing investment excellence is not simply about delivering excellent returns once. Rather, it's about delivering on an ongoing, consistent basis for clients, and we would argue, doing so while taking the risk profile of those returns into account. Joining me today to discuss how we focus on delivering risk-adjusted returns in our multi-asset portfolios is Chief Investment Officer John Gilchrist. So John, recently, PSG Asset Management won the Best Overall Performing Multi-Asset Manager in the 2025 Innate Invest Diamond Awards. Can you share the significance of having won this award with us?
Thanks very much for having me today, Audrey. And yes, we try not to focus too much on awards, but we do view this one as a particularly meaningful award to have received. And there are a number of reasons for that. Firstly, Innate themselves, a very credible participant in the market. They've got skin in the game. They allocate to asset managers. And we also know they have a very, very comprehensive and well thought out approach that they use. The other aspect that makes us really sort of focusing on these awards is the fact that they're over 5 years. They also reflect performance across not just one fund, but our range of multi-asset funds. So that would be our PSG Diversified Income Fund, our PSG Stable Fund, as well as our PSG Balanced Fund. But then most importantly is that these are not just purely about performance, they're about performance and risk-adjusted returns. And that for us makes them incredibly valuable, particularly because over the last 5-6 years, we have focused very closely on delivering the right sort of journey for our clients, and this award reflects the success of that focus.
So delving into the importance of risk-adjusted returns and how we go about delivering on that in PSG Asset Management. But maybe before we kick off, can you just reiterate why it's so important for multi-asset funds to focus on the risk-adjusted aspect?
Anybody that invests in a multi-asset fund is making an upfront decision by moving away from investing purely in equities into a multi-asset fund. They are likely over the longer term to generate lower returns. And the quid pro quo of that is they expect lower returns, but they expect more consistent returns. They expect lower risk associated with those returns. So anybody in a multi-asset fund has explicitly made that risk-return decision. And as a result of that, when people assess how funds in the multi-asset space have performed, they tend to look at not just return, but return and risk as well. And often the starting point for an assessment of the outcomes, the return and the risk, is a traditional risk and return type of graph. As we will show here, in the multi-asset high equity space, we have various funds shown here over 5 years. On the vertical axis, you have return, and on the horizontal axis, you have volatility as a proxy for risk. And as you can see, our PSG Balanced Fund, exceptional returns over the 5-year period, but the volatility is higher than a lot of competitors. Now, as a result, people then tend to say, well, how do you combine the aspects of risk and return? And as a result, they use ratios like the Sharpe ratio, which compares excess returns, so returns above the risk-free rate or returns above cash, divided by the volatility. So it's essentially a ratio of return and risk. And on that basis, the PSG Balanced Fund is also exceptional. So delivering very good absolute returns and doing them in a very good risk-adjusted way. We understand why the market uses return and risk as proxied by volatility. It's computationally easy, but as we've pointed out before, we do have some concerns with how prevalent this measure is. And some of those concerns are around the fact that volatility is generally based off monthly returns, and so it can lead to quite short-term focus. One poor month can look very bad from a volatility perspective, where it is not necessarily a significant issue for an investor. It also doesn't distinguish between good upside volatility. If a fund's up 3 or 4% in 1 month, it is penalized for that. as opposed to bad downside volatility. So it treats up and downside volatility equally. And it's also based on quite a lot of simplifying assumptions. So we are cognizant that the market uses volatility, but we're not managing to reduce that volatility. We want to make sure we give the best risk-adjusted return. So we tend to look more at downside deviation, which ignores upside volatility. It only looks at the negative downside volatility. Or more importantly, we focus on maximum drawdown. Ultimately, that's what the client's going to feel. If they have a significant drawdown in the fund, that is what is going to cause them pain. That is ultimately the risk. And that's where our focus tends to be, and we manage the funds according to that. And by not focusing on that very short-term volatility, it actually allows us to deliver better long-term returns for our clients.
So taking a broader perspective and perhaps taking a bit of a step back, PSG Asset Management prides itself on delivering ongoing investment excellence. So in the context of our multi-asset funds, can you give us an indication of how you set about trying to achieve those outcomes for clients on an ongoing basis?
Certainly. I mean, ultimately, our raison d'etre is to deliver exceptional returns for clients. So the starting point has to be, how do you deliver those exceptional returns? How do you outperform the client expectations? And so the starting point, and we've talked about it a lot, is that we look in uncrowded areas of the market. We look in parts of the market that the rest of the market participants have given up on. And those tend to be out of favor and hence relatively cheap. And that's a starting point, but then we use our 3M process, moat, management, margin of safety, to try to really identify the gems, that inherent quality that the market has overlooked within those out-of-favor areas. We do extensive independent research, and we pride ourselves on really knowing those opportunities very well and positioning ourselves accordingly. And that puts us in a very good position to generate those exceptional long-term returns. So that's on the return side. When it comes to risk, as I said before, we're focusing more on the maximum drawdown. And as a result, we're trying to create portfolios that exploit a number of different sources of return. And ideally, those sources of return are uncorrelated. And one of the things that we do differently from a lot of the rest of the market is we're a little bit more skeptical about historical correlations. We understand that these tend to be relatively stable, but if the valuations are distorted and are out of line with history, and if the positioning in the market is such that it is at extremes, sometimes those correlations can break down. And to make it tangible and real, we look at the end of 2021, the market generally had assumed for many, many years that you use your US bonds as your risk mitigating asset at 1.5% yield. We felt those bonds were expensive, especially as we saw inflation coming through to high levels, and that ultimately did come through. So we held no US bonds, even though they are traditionally your risk mitigating asset. And then through 2022, those bonds moved out. An increase in the yield is a loss on those bonds, and they lost significant amount of value, and they finished the year in excess of 3.8% yield. So that's a good example where we don't just rely on the history, we look at the valuation and we say, how will this asset class perform? We also make extensive use of what-if scenarios and stress tests to understand how the various components are going to behave in different environments. And we think that puts us in a position to deliver those good risk and returns for our clients.
So John, looking forward and talking about trying to earn those returns for investors, we find ourselves in a very uncertain and volatile macro environment. So how do you think are multi-asset funds positioned to meet this challenge? Can they do it going forward? And what can investors look forward to?
I guess it's a perennial question. Markets always feel incredibly challenging. There are always risks out there. It does feel from a macro perspective that it's particularly challenging right now. And certain parts of the market are stretched as well. We've seen markets came off aggressively in April, but they've rallied, and many, many markets, especially equity markets, are at all-time highs. But what we have found time and time again is that even if the overall indices and asset prices are stretched, there are areas of the market that are out of favor and generally quite cheap. Now, if equities sell off, if bonds sell off, for example, it becomes incredibly difficult for multi-asset funds to deliver on what is generally a CPI plus or inflation plus type of absolute mandate. That being said, there are pockets of the market that do offer good opportunities. And so we still think there is a great opportunity to continue to deliver very good returns for our clients, meeting and exceeding those objectives of CPI plus. But you have to be willing to go into those uncrowded areas. You have to be willing to be different from your basic competitor who tends to be very, very focused on the indices, and some of those indices are expensive. So being differentiated, going in and doing the hard work, we believe will put us in a very good position to deliver for our clients.
John, thank you so much for joining me today and talking to me about our multi-asset management process.
Only a pleasure, Audrey. Thank you.